Now, one Federal Reserve governor says the economy may slow to a crawl if all of this goes ahead with the full slate of tariffs. Christopher Waller says they could force the Fed to cut rates more aggressively, even if inflation's above the 2% target. And he says the Fed's outlook will be little change if tariffs are limited to an average of around 10%. In that case, he said there could be good news rate cuts later this year. Randall Kroszner is a former Fed Reserve Governor. Randall's with me now. How difficult is it for the Fed to navigate the policy decisions at the moment?
Oh, it's simple, very obvious. No challenges at all. No, of course, this is incredibly challenging because there are so many pivots, so many apparent changes, and so many challenges for the private sector because they're not quite sure how they should be doing their investment. And if they're not sure how they're going to do their investment, it's particularly tough for the Fed to be figuring out what the economy is going to be doing and what interest rates should be.
So at what point do you think the Fed does come in to offer some support?
Well, I think so. I think, as you were saying, Governor Waller has a very good analysis of the problem. Most likely, the tariffs will be a temporary boost to inflation because this isn't an ongoing thing. It's something that will go up and may boost inflation temporarily to substantially above where it is. It'll come back down. The Fed will look through that, and then probably they'll provide some support as the economy slows.
You see, that's the point. I think at the end of the day, tariffs are now at rates and levels we've not seen for more than a century. Therefore, there will be an economic slowdown effect on it. Are you able to give us an idea of how much that's going to be?
It's really tough because we don't know the extent of the tariffs and we don't know the extent of the response. I say it certainly will slow things down. And this is exactly where the president needs to pivot to say, okay, I'm going to be giving tax cuts to incentivize investment. I'm going to be deregulating to incentivize investment to try to offset that. And so we really need some clarity on how all the pieces fit together.
If it's an extension of the tax cuts that we've already had, or just merely more of the same, in your view, is that sufficient?
Well, certainly it's helpful. I mean, my colleagues at University of Chicago done some analysis to show that the immediate expensing of investment, which was done under the previous previous time Trump was in office, was very helpful for stimulating investment. So we need to do that, and perhaps we can do more. Would it be enough? I think it has a lot to do with the uncertainty around the policy announcements, and I certainly can't handicap that very easily.
You see, we're now in a position where no economic model. I mean, yes, the big banks and the economics, they've all managed to put together an economic model of sorts. But since we've not seen this tariffing level since 1908 or 1912, depending on your definition, it's not exactly a very robust form of science.
Well, forecasting is never a fully robust form of science, I would have to say. But certainly this adds another layer because, as you said, we haven't seen these kinds of things in quite a while. And it depends not only on the choices that President Trump makes, but also the choices that others make and how they retaliate.
Right. I spend a lot of weekend reading about the bond market. Yes, I really am that sad. And I'm still not fully sure, stripping out the fundamentals of the bond moves last week because of worries about economic growth versus the technicalities of the market, caught short coverings versus just the machinations of the yield curve. I can't work out what was the more dominant move.
It's I think you are not the only one. I think many market participants are trying to figure that out. Is this a long-term turn away from the dollar and a turn away from treasuries? Is this just a short-term move because there's so much tumult in the markets? And I think it's very difficult to assess that right now. Now, fortunately, the yield on the 10-year treasury has come down a little bit, and it's certainly below where it was earlier this year. So it's not like it's at record levels, but certainly moved up quite a bit over the last week.
What do you think that I mean, because at the moment, the three commodities, in a sense, bonds, gold, and oil. Now, they are the three that are, I would say, the cornerstone because they are so interlinked by the dollar, and they trade through the dollar and through the U.S. liquidity markets. And if a recession is on the horizon, we're going to see movement in those commodities and in those markets.
Well, we've already seen a substantial move down in oil, suggesting that people think that the markets think that there's going to be less demand for energy. That suggests an economic slowdown. Gold has moved up and down with uncertainties about policy and with uncertainties about inflation. And then obviously the bond market is, has moved up. The interest rates have moved up substantially over the last week. But as I said, they're not as high as they were just 2 or 3 months ago. So it's not like they're at record levels. So I don't think this suggests that this is the end of the dollar. Some people have sort of been rending garments over that. I think we're a little bit early to make that call because, as I said, interest rates are not at record levels. They're below where they were just a few months ago.
I'm grateful that we had your time today, sir. Thank you very much. Good to see you, Randall. Thank you.